to find the best suburb for investment, and that's across Australia. It's very easy to hear from media, oh, WA is going very good, oh, South Australia is going very good, or Queensland is going very good. But where in Queensland? It's not entire Queensland. We've got a large network of agents who are constantly able to provide us properties which are off-market properties and are helping us with the reach and being able to offer clients better options, better choices, better properties to make their wealth dreams come true. All right, I think we are just about at time, and do you think we wait for a few minutes? I think there's a huge number of people who have already joined in. Do you want us to wait, or do you want us to start off right now itself? It's just about 7 p.m. We've committed to finishing in time. So I think we can move on, and we can talk about what our topic is today. All right, so here we are, both of us, Julius and Parag, and here we are here talking about how to find the best suburb for investment, and that's across Australia. We are talking of what do I do, how do I research, or how do really buyers agents research and find out about which are the best suburbs. We all want to buy properties. We all want to be there, and we all want to be right there at the right time. For example, Melbourne 2 years ago, so Victoria 2 years ago, very good, booming, everybody wanted to buy there. Not so good right now. We have suburbs like Western Australia, lots of suburbs in Western Australia, booming till about 6 months ago, just going up every second week. They're still going up, don't get me wrong, but maybe not every suburb is going at the same pace. So where do I really go? Which one? NSW? South Australia? Which one's my next winner? And that's where the whole question is. That's the question we are trying to answer today, of how do we find out where we can go. Anyways, so that's the agenda for the day in front of you. What we are going to talk about today is, first, obviously, what's Propwealth, why Propwealth, what we are doing here, how do we begin our research, what do we really do, how do we do and find a suburb. There are 50,000 plus suburbs across Australia in various states. What is the definition of a good suburb? That's the big question. What is it? What is the key matrices which come into a good suburb, which we need to see? Which are the important ones which define it as a good suburb? And then we're going to touch upon ownership structures, which really help you get into multiple property scenarios. When you identify 3 good suburbs, or 5 good suburbs, or 10 good suburbs which suit you, can you really buy in all 10 of them? Can you really go forward and talk and say, okay, I want to own everywhere? That's where the choice, the matrices come in place. That's where the ownership structures come in place, so that you can maximize your resources, maximize what you can get out of that, of your money, of your deposit, of your borrowing capacity. What are we able to do? That's where it is critical. And then we will going to touch upon Propwealth Next. Propwealth Next is something which is a fantastic algorithm, fantastic mechanism which has been made. We'll show you a few bits of calculations, what we do. We'll show you a bit of a analysis of how do we reach into finding the suburb out of all of them, so many of them, and then the data points which are there, data points which we have really collected. Everybody talks about being a data-based and research-based buyer agency, but what does Propwealth really do to be able to say that we really are the ones? What data? How do we analyze that? That's going to come in Propwealth Next. And it's an exciting time. The really exciting time about Propwealth Next is going to be in about a month and a half or something, when we are going to release that software free of cost to everyone, to be able to analyze and to be able to see a suburb and see the matrices around it and read through about what's good and what's not good and what's beneficial in that suburb. But that's for the future. But today we are going to stick to this agenda. Who are the speakers? I would welcome Julius amongst us. Julius, everybody of you knows, so many people actually have taken benefit of his services. He's a buyer's agent by one of the best by far. He's been there in the tech industry. He's been there for more than 15 years, has been in New Zealand. He worked along with CoreLogic and very honed his skills. He worked in data research and algorithms out there. He's got a big hands-on experience in property acquisition. He's got a big hands-on experience in research, and he's an investor both in Australia and in New Zealand, has multiple properties, has a large portfolio of himself. Joined by myself, I'm from Nfinity Financials, and I'm also associated with Propwealth. Been ranked, lucky to be ranked by the clients, lucky to be ranked by the banks, by institutions as top 5 broker, top 10 broker across Australia. Been various years. I've consistently been the top 10 for quite a few years now. Thank you everyone for your support. I head one of the best mortgage companies across Australia today. We have been completely customer centric, and that's what that's why we are associated with Propwealth, so that we can bring the same value across to you. I've been again lucky to be in the industry for quite so many years, so that's my gray hair does talk about that and brings that to the table again. Okay, why Propwealth? Propwealth is really a data research based buyer agency. It's a very cliche word. Everybody talks about it, but we are going to see today and see the proof in the of why we do that and how we do that in a few months, as I just said. But right now, we'll show you a glimpse of that data industry. So what based buyer agency, what we've done. We've done more than 350 deals which have been done in the last 1 year. More than 240 million of purchases have already been done by people. We've got from the equity which has been generated, valuations which we keep on doing and passing off to the clients at times. More than 36% of equity has been generated, and that's very critical. And that has all come out from the experience what we've gained and from the database, the algorithm which we've made in Propwealth Next. That's all helped us out. We also are lucky in terms of having a footprint across Australia. Any state you want, we are there, and we've got a large network of agents who are constantly able to provide us properties which are off-market properties and are helping us with the reach and being able to offer clients better options, better choices, better properties to make their wealth dreams come true. But okay, before we really get into this thing, I really wanted to ask you a question, and it's a very simple question. You and me, individuals, forget about Nfinity, forget about Propwealth. How do we really begin our property search? And that's the critical one. Most of us, I'll call my family, my friends, my neighbor, my good mate, my office colleague, friends who made an investment at some point of time, all of these guys are my reference point. And that's where I go. Okay, where did you buy? I'll go and buy there. Oh, what did you do? I'll go and buy there. But like I said at the earlier point of this part of this webinar, if I bought in Melbourne at some point of time and Melbourne was going good, maybe I am not doing so good today, because it's not going good. I can still go good. Obviously, I have to go good. Melbourne may come up. Victoria, we are all expecting in a couple of years, 3 years, it will jump up and we'll have a capital gain. But I have an opportunity cost as well. Am I better off investing today in a WA or in regional NSW or in Queensland and make more money out of my same money, or I am willing to park my money into a state where I'm okay? All this stuff, how do I really search? Typically, that's what people do. Not a great way of searching, not a great way of trying to create an investment portfolio. You may be lucky, definitely you may be lucky. You may do the right moves, you may be able to do that, and you may be able to really reach out at the point where you can invest. But again, investment is not based on luck. Investment is always based on fundamentals, and that's what we are wanting to do. This is the important one. What is the definition of a good suburb? And I would request Julius to take us through this and take us through what it really means.
Okay, good evening everyone. So when we look for the good suburb, right, there are two fundamentals. Either you're looking for a suburb to live, or you're looking for a suburb for the investment. So we'll put the poll to understand and then we'll give you a quick 30 second.
What we request from you is in the chat,
Yeah.
can you just say, what would you think? Is it right? Is it a yes if you think that a good suburb to live or a good suburb to invest are the same? Or you think no, the way I would choose a suburb in which I want to live and the way I would choose a suburb in which I want to invest are different. Choose yes if you think I will think the same way. Choose no if you think you will think in a different way. All right. All right.
Yeah.
Quite a bit of a yeses, quite a bit of a yeses,
Yeah, there are a lot of yeses.
quite a few yeses. There are a good number of no's as well. All right. So a lot of yeses. Maybe Julius, if you can take it forward.
Yeah, okay. So when we look at the suburb which for living or investment, so there are different categories about how you select the suburb. For an example, if I would like to if I want to buy a property where I would like to live, right? I would look for schools. I look for the good transport facilities. I look for the better markets. I look for my friends and family circles, and these are like a fundamentals where you just wanted to go and live. So it's a lot of emotional attachment. But when we look at the investment, right? Investment and living are both have two different fundamentals. In investment means basically we have to look for the number. So for an example, if I wanted to look for the suburb to invest, my first factor would be affordability, whether I can afford into that suburb or not. Affordability for the living versus affordability for the investment has two different aspects. Affordability for the living means basically, yes, I would like to live in a suburb where I can afford the max, and then probably I'll take most of my borrowing, I'll go and live there because you want to cherish your memories there. You wanted to live with your family. Your kids will grow up there. In terms of the suburb to invest, right? There won't be more emotions. Over there, the affordability means, okay, wherever my remaining borrowing capacity is, or for an example, I could afford a $1 million property for the investment, but the returns on that property would be around 3 to 4%. Versus, I can buy two property of 500 each, which can give me a 6% return with a similar capital growth. So during that time, the affordability takes place. Second thing is, wherever the more affordable suburbs are for the investment with the good fundamentals, there are more chances to get a good capital growth versus if you go to the more expensive suburb, because chances of getting the more capital growth will be limited. Second thing is vacancy rate, like wherever I'm buying, for an example, whether my property will go on rent or not, and then how many percent properties will be vacant. So vacancy rate is a metric which is very, very, very important. So because when you buy the property, you often want, okay, if my tenant is leaving or my property is settled, how many days it will take to go into the rental. So wherever we see very low vacancy rates, these are the places where we have to go and buy. So that is one of the most important factor. Third important factor is demand and supply ratio. So demand and supply ratio means basically wherever the supply of the property is very limited and demand of the houses is very high, during that time it's a rule of mathematics that basically the properties prices will tend to go up. So we have to find out through the data matrices how is the current demand and supply ratio and why it is going down, because we have to look for the trends. There'll be times that, okay, currently there'll be very high demand on the property, but there'll be a lot of approval spending in next 6 to 12 months, and then there'll be a lot of supply coming towards the market. So we have to analyze, and then we have to define wherever the actual demand is very high and supply is very low, we have to look for those type of indicators. Third thing is the socioeconomic. So socioeconomic, when you look for the suburb for the living, then probably yes, if you can afford, then probably I would like to go and look into the high socioeconomic suburb. They will have the good income, good tenants, good people, good schools, good parks, good surrounding. But when I'm investing, right, we have to look for the suburb where I can go and still invest into the high socioeconomic area, but there'll be cost to pay. And as I said before, if the area is least affordable, then there'll be least chances of the growth versus there'll be a lot of out-of-pocket expenses. So in a case, if you're looking for the suburb where the socioeconomy is mid to high or low to mid, where we can actually see on the footprints of having a gentrification. That means people or commission houses are going out of the place and then they are moving towards a different side of the city or state, and then there is a strong changes into the socio-economic area. Then we have to get into those pockets where, because property investment is a long-term game. So wherever, if we'll get into the low to mid socio-economic area where the prices are affordable, and then if my demand and supply matrix is matching to that, then that's an important factor. The fifth is the infrastructure, and then what kind of infrastructure is coming there. We have to analyze it very carefully whether the infrastructure growth is coming up to serve the existing community, or the new infrastructure is coming because there are new projects coming up. If there are new projects coming up, that means there will be more population growth because new migrant workers are coming up. So basically we have to analyze this, whether the new infrastructure is just because of to serve the current community, or the new infrastructure is coming up because of new migration of the worker. If that's the case, then that's a positive side. So we have to look for all of these things, and we have to look for the impact of that. So for an example, how each metric will impact on the capital growth versus the cash flow. Because the prime objective to buy a property is to make money out of the property, which is your capital growth. For an example, if I'm buying a property of 500,000 and if I'm getting a appreciation on the property which is 20% in 1 year, which is $100,000 growth, that's called capital growth. But it doesn't mean that my property is renting at around 2 to 3% of the property price, and then my expenses to the property is 6%. So that there'll be a lot of out-of-pocket expense. So for an example, when we look for the affordability, better the affordability means it will lead towards a capital growth. So if you wanted to achieve a maximum capital growth, we have to look for the good affordable locations where the other supporting factors are matching. Next is the vacancy rate. Lower the vacancy rates, it will lead towards the good cash flow because your property will be always on rental. Plus, there will be very less vacancies in the market. So you can always look for the rent rise. So it's impact on your cash flow. Then when we look for the demand to supply ratio, that metric will impact to the capital growth side of thing. If you're buying a property in very high supply area, and wherever the demand is lower, then your capital growth will be very slow. So we have to always look for a high demand to supply ratio. Then the socio-economy. As I said before, if the socio-economy is less, and then if the area is gentrifying, then with the time and whenever the area will be gentrifying, the property will have a more capital growth. And then the last factor would be infrastructure. So as I say, if there are new jobs creations happening, if there is a more population growth happening, and if people are earning more with the new infrastructure, and if the supply is lower and demand is higher versus vacancies are lower, then it will lead towards the capital growth. So we'll go more in depth about how the demand and supply, how each metric will work. So for an example, for the supply side, when we look for the demand and supply ratio, right, there are a few supporting factors. So for an example, stock on market means basically at a given time, how many percent properties are in the market for the selling. Whenever the stock on market is very low, with the supporting factor of inventory, that means for an example, in the entire time, the amount of inventory which is in the market which is less than 2 months of inventory. In our system, we calculate in between 1 to 2 months. If it is more than 3 to 4 months, that means it's a neutral supply. And if it is more than 4 months, then probably it will be high supply of the properties. So inventory, how much is the current inventory into the market? How much is the current stock on the market? Number of building approvals will impact on your property growth as well. If suppose the supply is lower, demand is higher, but for an example, in next 12 to 18 months, probably we can see there are like 15 to 16% of the more properties coming into the market because of the higher building approvals. Then your stock on market and the inventory will change immediately, and which will impact on the demand and supply ratio. And then fourth thing is a hold period. Hold period will define as basically how many years the people flip the properties. For an example, if hold period is less than 3 to 4 years or 5 years, that means these are the area where there are not a lot of people who are stable. There are a lot of flippers. People just come there, buy the property. When the property prices increases, then they sell the property. So it will be investor driven market where the renters into the market will be too high, and that's a riskier market. So hold period is also very important market metric. When we'll go for the demand side, right, that's the actual metrics where we have to calculate, because when we look for the property cycle, we have to find out the bottom of the market where you have to enter, and then we have to reach to the peak so you can get most out of your short-term growth as well as a long-term growth. So days on market means how many days it will take to take the property to sale. When we see the trends between the days on market which is going down, for an example, from last 3 to 6 months, days on markets are from 60 days to 55 days, and then if it's constantly coming down, which is a good sign on the property. Then vacancy rates, probably the vacancy rate will be around 2%, but they're constantly going down. And if the vacancy rates are below 1%, they are phenomenally good, because your property will always have a demand. Third thing is the search interest, where, for an example, at a given time on a single property, how many percent people are looking for the property. Whenever the search interest is going up and up and up, that means more investors or the more people are looking at the property, which will impact on a demand and supply ratio, which will lead toward the capital growth. And fourth is auction clearance rate. Basically, when the market is lower, that time the auction clearance rate will be lower. But when there is a hot market and then where everybody would like to get into the market, if auction clearance rate is increasing, that means there is a lot of confidence into the market. So these are like basic demand and supply related indicators. Next is the demographic. So the first metric is the population. Why population growth is important? Because for an area where there is a population growth, and then we can see a projected population growth, that means that basically, yes, there are a lot of people who are going to move to that suburbs or the council, where you have to find out there is not enough supply of the properties, but there is a high demand. Because population with growth will always impact onto the demand and supply ratio. More the population growth, there will be more demand to the property. If there is less supply, there will lead towards the capital growth. Third thing is immigration. So immigration, because when we go to the ABS, we can see, okay, when there will be more immigration, then we can easily calculate from our system which area will be more impacted with the more new immigrants. So because when there will be immigrants, that means there will be more demands towards the property rentals. So your rental vacancies will go down. So the immigration is very important factor. Third thing is income. For an example, if the median income are constantly increasing, what does that mean is basically there will be area where affordability is higher, supply is lower, demand is higher, and then people's incomes are keep on increasing. That means there will be more affordability towards the families because of the more disposable income, and then they'll put more money towards the property because they can afford it, because they can borrow more. So that's how when there is a strong medium income with very limited supply of the properties, that's a positive sign. And then socioeconomic index. So as we said before, when we go towards the socioeconomic index, wherever we'll go with the mid to low socioeconomic area, whether the gentrification is happening, that will lead towards a high capital growth and the gentrification. And then the last thing is future projects and the infrastructure growth. So future projects will be like, it will create the more job opportunities. As I say, the infrastructure growth has two things, like the infrastructure growth is happening just because to serve the current community. It will not impact much onto your property prices. But if suppose there are the future projects coming up, which will create enough number of jobs, that doesn't mean that basically there'll be mining project and then a lot of people will come and then they'll go. We look for the projects which are more stable, which can create thousands of jobs for the permanent or for the long-term basis. That will impact more towards where a lot of workers will come in, and then and if there is a gap into the demand and supply ratio, then your property prices will go up. Then the biggest thing is socioeconomic changes, where you're getting more hospitals, school, shopping center. If there is a rezoning happening, that means if you're holding a bigger land, then you always have that opportunity to subdivide the land and sell it for the higher prices. I'll hand over to the Parag now.
Yeah, so on the same note, what defines affordability actually? Affordability will be more important when you are able to actually buy. So you got, say, $500,000 or $200,000 as deposit. Can you buy one? Can you buy two? Can you buy three? Can you buy five properties? Are you able to really afford to be able to buy multiple properties. That's important. And sometimes, with the wrong structure, with the wrong ownership structure, what happens is that you may be able to afford to buy up till say $1 million, but just because you went into a wrong structure or just because you went into a wrong property, you may find that you're not able to leverage the benefit which you can out of what you are wanting to invest. Ownership structures are very critical, especially the ones in which you can use multiple resources at your hand. It's typically correct for people who want to have multiple property portfolios. There are people who will say, I'm happy with one, we're happy with two, I'm fine. There are people who come to us and say, I want to have a multiple property portfolio, a large portfolio, a portfolio of which is mixed with properties across various states. That's where structures start becoming important. Individual structures, typically individual structures, personal portfolios, very nice. It's easy. It helps you in negative gearing. It helps you in tax benefits. It always helps you in land tax because you get thresholds in all the states, and it helps you multiply that. But one drawback of individual structures is it really exhausts your borrowing capacity very fast. I've got numerous clients who would come to us after they bought one or two something properties in their own name. They've got decently high income, but they're stuck. My first property, I just went with my heart, did something, bought something which is right, not right. Now I'm stuck. I'm not able to ride the wave in WA. I'm not able to ride the wave in Queensland, not able to ride the wave in the other states. And I'm stuck in a state where I'm not really getting the gains which I want to get. Typical issues in individual structures. Trust structures. Lots can be said about trust structures. Lot of types of structures. Unit trust, family trust, benefits of unit trust, very large benefits. You can hold multiple portfolios. You can really be in one trust, buy your properties there. And if you're able to show that trust is positive in itself, can take care of itself, there are lenders which are willing to avoid taking that liability. Helps you create multiple portfolios. Obviously, you should be able to afford it. It's not about just getting a loan. You should be able to afford the loan, get the money, able to repay nice and easy. You don't have a stress on the cash flow. You can hold multiple portfolios across multiple trusts. Land tax benefits, you get trusts get their own thresholds which you are able to utilize. You can distribute rental incomes to people, family and others, your friends, or if someone you want to, if you're having a good income being generated, make it a good tax structure after speaking to your accountant, obviously. Then one other benefit is pass on to the family members in generations to come. SMSF becoming very popular now. One of the reasons of being popular is because people want to take control over the SMSF in their own hands. They want to invest through that. They believe that they can do a better job than the super funds in which they are to be able to invest. You can get a capital gain benefit out of your SMSF investment. It's a discussion with a financial planner and accountant, but typically if you're selling at a time of retirement, basically your property is capital gains free, which is a massive benefit. Just imagine your property which you bought for $500,000 today and it becomes $1 million in some point of time. That's all tax free, similar to what your owner occupied property is. Or even if you sell it earlier, the tax threshold is pretty much lower at 15%, much lower than most of the people which is there. These are the benefits which you get out of trust structures and SMSF and individual holdings. When you're trying to get into your affordability game, two parts to it. One part is that market really where you can buy a property for an affordable price? Second is, can you really afford to buy there? I find I have friends who are living in Kellyville in NSW in Sydney. I have friends who are living in Bella Vista, in Bockham Hills, in Castle Hill, in Ryde. Fantastic areas to live in. Good money to pay when you want to buy a property. Pretty expensive, but do you want to hold an investment there which can really block off your borrowing power? Maybe not for everyone. A lot of people would think about it. That's where ownership structures become important on whether you can afford, whether you can buy multiple properties, whether you can have a portfolio of 10, 20, 30 properties. How do you go there? That's what's critical, and that's what we would advise you to first speak about. But yeah, exciting one. The most exciting topic today is how do you really analyze this data? How do you really go to it and find the next great suburb to invest? And let me invite Julius back onto it to talk about it.
Hi, so introducing Propwealth Next. Basically, what is Propwealth Next? Propwealth Next is a metrics and the software which we have made in-house to understand and find out the best hotspot across the country before someone else reach there. So basically, in terms of the investing, right? Like they are like in Australia, there are more than 15,000 suburbs. So how do I come to the conclusion that what would be my next $1 million suburb? How do I find that suburb? There are more than 40 data points. Now there'll be more than 100 data points. Which data point to select? How do I filter those locations? Whether the property or suburb which I'm trying to find out, whether that will go in a short-term basis and long-term basis, because there are two growth cycles of the property, short-term and long-term. Either we can get into the both. If you don't do analysis properly, you will be stuck into a short-term growth cycle at the peak, and then your property will have a zero performance. Why that entire area will grow fundamentally. So to study all of this, it requires a lot of data analysis, and that's how we build the Propwealth Next. So in Propwealth Next, we get a bunch of APIs, and then from the API, we pull a lot of data from the different sources. We collect the data. We have an in-house algorithm which defines us, okay, with the risk score, and then we have a different matrices like demand and supply is not the only metrics which we are working on. Demand and supply is very, very important metrics, but that will lead to the short-term growth. So our entire system has been designed by multiple metrics like affordability, socioeconomy, population growth, demand and supply, and the future prediction. So we just introduced the gap analysis as well. So basically in Propwealth Next, so this is a glimpse of like what we do. So in entire Propwealth Next, we have something called as a radar, where we define the risk of entire areas and then all the matrices. So whenever we do the research, right? So statistically, the entire Australia is been divided by the multiple sectors by the ABS. So that is called as the statistical area 4, 3, 2, and 1. When we look for the research, statistical area 4 means a bigger area where multiple councils are part of it. Statistical area 3 means a council. Statistical area 2 means multiple suburb within the council, and statistical area 1 means basically small subset of the suburb. When we look for the research, the most important thing where you will get more accurate data when you go towards the bigger boundaries, which is the statistical area 3. So in Propwealth Next, what we do is basically we assign the score on each statistical area based on affordability, based on the incomes, based on the buying affordability as well as the renting affordability, based on the demand and supply ratio, based on the job categorization risk, based on the socioeconomic index, and according to our algorithm with the median prices, we come to the conclusion that okay, what is the risk factor and the score, Propwealth score for each factor, and according to that, when we filter that, then we come up with a good council which will have a short-term and a long-term growth. Because short-term growth will come when we look for demand and supply ratios gap. But in long-term growth, okay, there will be a lot of councils where the incomes are more than $2,500 a week, but the median prices of the properties are around $650 to $700, where there is a lot of gap in a demand and supply ratio, and there is enough demand created where the people can afford to go up to the $1 million. So those are the suburbs where we can go look for the $1 million suburbs. So for an example, when we look for those type of councils, within the councils, we look for all the locations, we look for the suburbs, and according to the budget, we have to come to the conclusion of the suburb. And then we go to the property level due diligence, whether my property is a perfect fit for me within the suburb, whether my property is on the correct street, whether my land size is correct, whether my land shape is good, whether my property has easements, whether my property has covenants, is there any high tensile wire behind my properties, and all of this. So we incorporated the entire due diligence system within the Propwealth system. So basically, when we look for a next suburb where to go, So we just have to enter the few matrices and then it comes out with the result. So these are like few glimpses. So when we look for on the first screen, all the top left till are the demand and supply related indicators, as well as when you go towards the extreme right, these are the indicators for the affordability. So when we look at the affordability, right, affordability consists of the income, affordability consists of the current interest rate. There are two types of affordability which we are looking at a given time. If the median prices are $650,000, whatever the current income is and whatever the current interest rate, how many years it will take to repay that entire home loan of median prices. So if it is below 30 years, which is good, versus in Australia, we look for another type of affordability where how much times your income versus the property prices. If the number is below 7 or below 8, which is good, because, and then if it is more than 8 or 10, which is like moderate. In Sydney, it will be around 15 to 16 times. So it's a bit on average, but we are sitting at very high interest rate. So this is on the first slide. When you look for the second one, basically these are the census related data and the socioeconomic index, where we look for, okay, how is the socioeconomic index and whether there is a population change with the gentrification is happening, whether good kind of population is happening. In that population type also we have categorized with, okay, what kind of population, what is the age group, whether the young families are moving or retirees are moving there. For example, if young families are moving, then how much are the parents earning, and then what is the age group, what are the renters, how many percent people are owning the entire home, how many percent renters are coming up. So we have incorporated all this data into the next steps. This is just a backend of our system. This is the average CFA index, where we'll see for the affordability. Then look, and then the last slide is for the basically a job categorization. So basically what we need to look for is wherever we're investing, whether they are prone to a major job risk failure. Like there are few areas across Australia which is prone to the mining or single industry. So we have categorized all the industries within the system, and then we give them a score with the percentages. So wherever the major chunk of the job, which is more than 20%, where when you look at the dependent work, then it will be around 60 to 70%, then we mark this as a high risk. So that is called as a job categorization risk. So we divide that into in SA3 and SA4 level. So we know, okay, in the entire council, how many percent people are actually dependent on the mining, the forestry. Like I was researching the data about the Mount Gambier yesterday, and then what I've seen is around 30% of the people are working supported by the forestry, and then they chunk which is on the fisheries. So that is like a single industry dependency, and we don't want that. So we have incorporated that data into the system also. So and then we have assigned the weightage to the every metric, and according to that we have defined the score. So that's a glimpse of our backend. Okay, so we'll show you that glimpse later. We'll release on the site. So what are the next investment location according to the today's market for a few months? So Propwealth Next, in the Propwealth Next, when people were buying expensive property towards the regional Queensland, especially towards Mackay, there's a lot of competition in Mackay, Gladstone, Bundaberg, Townsville. We have identified the regional NSW location, and then that time the vendor discounting was around 7 to 8%. We have started buying the properties over there with our predictive analysis system, and then and now currently the market is going towards the lower supply and the higher demand. The search interest is going up. Basically, when we see the online search interest is going up, there is a lot of demand on the property, and vendor discounting has been changed from 7% to 1%. So this is the power of the data, and that is what we have built into the system. So these are the few locations where we can go and invest at a time, and these are the next booming location. So when you look at the entire South Australia, we look for the councils. So in South Australia at this stage, the good council which is going to have a good performance will be a Treaty Gully Council because of the multiple government fundings as well as very low supply. In Western Australia, focusing City of Bunbury is looking too promising. with multiple government initiative and the projects. In Queensland, we are looking at Tweedshire Council. In NSW, basically, there are multiple councils now because regional NSW will go through the good boom cycle in next 1 to 2 to 3 years. So basically, we can look at Shoalhaven, Lytton, and the Wollongong Council. And then in NSW, Victoria border, the great pockets to invest now is basically Albury and Wodonga.
So yeah, absolutely correct. So Albury and Wodonga has been there on the radar for the last few months. Now, what we have seen in Albury and Wodonga, which are twin cities on side of Victoria and NSW, such a great example of what Julius has been talking. We've seen employment going up. We've seen people trying to move in there. We've seen people trying to be there, and that's where the investment's gone up. It's just boomed. It's just gone through a very different phase in the last 6 months, where people have now got a fantastic return, who early adopters of that locations, people who invested 6 to 8 months ago, and they are still moving up. This location is going to be a next fantastic one for all of us. Similarly, if you see Lytton and Shoalhaven, they are such great suburbs to invest in NSW. Suddenly you will find that the landscape of NSW is changing because of the way government is investing in there, because of the way population is moving towards there, because they still bring proximity to Sydney, they still bring proximity to employment, they still bring a fantastic infrastructure which is again moving up. There is so much of an employment being generated by the initiatives out there. Tweedshire in Queensland, again, it's a suburb where Queensland government is investing so much into it that these pockets are going to be the next pockets of growth. And you can see that in maybe from now in 6 months from now, you will see in all of these areas, people who have invested will find how it happens. If you were to speak to Julius, if you were to speak to me at a separate note outside this webinar, we can show you the research about how the buyer interest is now creeping up there, how the stock is moving in a favorable direction where people will want to invest, how rentals are becoming stronger there. You can get good rental yields out there and still prices are lower. Great areas there, great suburbs there to be able to find and to be able to invest into. I think Tea Tree Gully, everyone has spoken so many times about Tea Tree Gully, and so many articles have come in through for that it's a choice suburb for all of us. And that's where, as Julius says, these are the areas where we have to concentrate, where we are going to concentrate as Propwealth. And we've seen clients concentrate as Nfinity Financials about investing there and moving forward to get more and more properties so that they can find out what they can benefit in those areas. Very good options, very good suburbs, very good locations to invest in, and data backed as well, which we can obviously share if we have an opportunity to talk to you one-to-one. And the important reason why we are saying what people have been speaking about us because of these data-based investments is how much of an expertise we have. What's the trustworthiness which they find in Propwealth, the professionalism they find in Propwealth, the commitment they find in Propwealth, because they have been talking through their heart. They've been trying to give us about data which is more and more, which is more invaluable. They're trying to talk about how the market is going to move and trying to make a good job of it. It's a great team to work with. Some of the words which people have been speaking about us. Why is the window of opportunity now? Good question. And why are people looking at finding the suburbs? Why do you want to really find the suburbs to invest? Because we all believe in the opportunity which is existing with us. We all know, and it's a pretty good common knowledge that we are expecting the prices to move up. There is a massive demand-supply gap which is there, which Julius has been talking throughout this webinar. We've got a pretty slow construction pipeline. There's been a impact on the builder industry over the last few years, and it still continues, and they're still not recovered. And there's a much weaker pipeline of construction, new construction. That is why the demand of existing properties is even going up further. Interest rates, no, pretty common knowledge, definitely going to start easing down. We are having a huge infrastructure spending in most of the states. Government stimulus is coming towards first home buyer, and they are taking over some of the markets. You can see that in Victoria, their first home buyers are just taking over the market, and the renters are going down. A different problem for investors, but still you can see how government stimulus and how actions by government can change the property there. Again, something where a unit market should or may get impacted by the recent activity by the government, but some things which make an impact on you. And it's very critical to find the right team, very critical to make the right moves, very critical to find the right suburbs so that you can really invest into your future. What does Nfinity and Propwealth bring on the table together? What do we do in helping you out and getting you the strategy and helping you execute what you want and helping you really find out your suburb? As we spoke about the tools which are there available with Propwealth and with Nfinity Financials, what we also do is we sit along with you. We're not just this is the property take. If we understand your goals, you may not fit with South Australia strategy. You may fit with a WA strategy or a Queensland strategy, because those are the strategies which are going to be applicable to you. Those are the ones which really benefit you because they suit your style. We understand those needs from you. We understand and make a strategy as per that. We present you with the better options which are there. When you've already come on board, we keep on analyzing your data. We try and understand how we can help you build the next one, and the next one. And that's the tool, Propwealth Next. That's why it brings you the next one, always the next suburb which helps you out. We do the yearly reviews, and we obviously bring across more updates across to you. And if you're looking to invest, if you're looking to do, and if you're looking to add to your property investment, that's not a bad. It's a good way to approach. You just talk to the expert, talk to us, talk to Propwealth, talk to Nfinity Financials, and understand where you can go forward. What we are going to do now in this phase of our presentation for the next 10 minutes or so is that we are going to take a lot of questions from you about how we can. What do you want? What kind of support would you want in finding out the suburbs? What kind of support do you want on really implementing the knowledge which you get about finding a suburb? It's not only the suburb which is important, it's about the whole strategy. How you would want the suburb, the one suburb in which you want to invest in. Get into your own strategy for your growth, for your wealth generation, for your property growth, and for your needs. What we want you to do is at this stage is, if you want to have, obviously we are taking questions now going forward in the presentation, but you can also reach out to us, book an appointment, or take a one-on-one appointment. Our contacts are freely available online. They are here as well on your screen. You can call us up. You can call up Julius. You can call up myself. You can go to our websites of Propwealth. You can go to the website of Nfinity Financials, book some things up. And if you are wanting to talk, we are there for you at any point of time. But we are now opening our thing to questions, and then we can go forward with. We'll take your time. We've got 10 minutes left in the webinar. We would love to answer as many questions as you have. Even if you want to see a demo of the of Propwealth Next, we are more than happy to take you forward. We are more than happy to book an appointment, just show you what it is, and then obviously in about a couple of months it will all become live. And then you can obviously see and put in your suburb and get a lot of data about it from that place and see what makes, and you can make a good decision about it. But question answer time, queries time. Let's go to queries and let's go to questions and then go forward with that. All right, Julius. So first question, let me take this one. I'm sorry. Can we have multiple properties under one trust? Yes, obviously. So can you have multiple properties under one trust? Definitely. So you can buy 1, 2, 3, 5, 10, 20, whatever number of properties under one trust. Absolutely no problem. The reason, if the underlying question is that, the reason why people have multiple trusts is to be able to build a larger portfolio. So for example, you've got one property which is, say, this is just a hypothetical example. You've got one property which is, say, $500 negative and it's eating into your cash flow, and you bought that into the trust. Then there is another property which is, say, a duplex is there on that property, and that's $700 positive. And there is another property which is $200 negative. All these three, if you bought under a trust, it's kind of neutrally geared. Very shallow example, not an in-depth example, but just to make you get a feel. You can buy these three properties, and those three properties with this can really help you out and balance out the portfolio in a trust. And then if you feel that, okay, I'm running out on my land tax threshold, if you feel that I'm running out on my or I'm happy with this trust to be there, and now I want to utilize the other government benefits and taxation benefits, and I want to move into doing another trust, you can move. Otherwise, if you feel I can still buy 2 more, 3 more, 5 more, you can do that. Very simple as an option. There is no minimum or maximum in a trust. SMSFs, different ball game altogether. SMSFs is a very different legal thing which comes in there. One bare trust, one property, no questions asked, nothing else. That's the way it is. Even if you have a house and a granny with 2 separate titles on one property, if you have 2 titles, 2 separate bare trust, 1 title, 1 bare trust. That's the way it works there. There are more stuff in SMSF, but yeah, that one, you will stick to one. Otherwise, multiple trusts, no problem at all. Okay. There's another question. Now that's for you, Julius.
Yep.
Yeah. I'll just read out the question to you, or you can read that out. Yeah.
So the question is related to the ABS data. So the question is, ABS census data related to the income was 2 years old. So how the data is current? Okay, so when we consider the data related to the income, right, it comes into the averages. Second thing is, there is a top line and the bottom line. So when we take out the average, with that, every year we need to add around 3% of the CPA, which is a normal average income growth across Australia. Also, there are multiple sources to get the corrected income data now from the domain insights matrices also. So when we talk about the incomes, right, income means it's an average income across the council. It doesn't mean that what every family is earning. So, and then if for every year, for an example, every year if you're not doing a census, so data which is going to be add up or going to be changed every year, it would going to be 3% baseline. So we are going to add around 3% to the average incomes to get the corrected or near correct data.
Okay. The next one, Propwealth next. Will there be any subscription charges?
It's free. So basically, there'll be 2 phases of the Propwealth next. The first phase will be around the geomaps and the trends, and then slowly we'll be introducing all the functions which you use internally. So you can, from that software, basically you can download the reports for your research. You can research about the council. You can drill down up to the suburb level with the filters which we have provided, and then these are our unique filters with the gap analysis. So yes, it's a free of cost basically.
It will always be free of cost. Yeah. There's no plan on the table to make it paid. Yeah. So all the research, all the great data, all available, maybe in a month's time. Next question.
Victoria markets, what's your views? So Victoria, it's very different territory. So as I said before, every state performance is different. Victoria is a place where you have a land supply on 360-degree. So it's growing omnidirectional. So in Victoria, there'll be a lot of options available when you change your budget range. At this stage, there are a lot of affordable pockets within the Victoria, which should go up. And we can see the trends on the ground that there'll be more interest coming from the owner occupier because of that affordability. But whenever you cross a certain number, then you have a next suburb which is better than that. So there are like very few pockets within the Victoria where you can definitely go and get your and we'll have a good capital growth. So market will be stable. Currently it's going to the turbulent phase. It will be stabilized soon. Another thing is basically it will take some time to recover. But there are few markets within the Victoria which can see a little bit of positive signs. So if you're buying in Victoria, doesn't mean that it is going to have a overnight impact. So it will take some little time.
All right. Okay. I'll take the next one. Can I use personal money to buy under SMSF? Okay. First and foremost, it's a pretty long thing, but I can just explain on a very quick note. SMSF is your super money. It's self-managed super fund. It's your super money. Very, very loose kind of a statement, but you become equal to an Australian super or an AMP super or all of these super. So when you set up your own SMSF. Now, when you want to use your personal money, which I am assuming is sitting in your offset or in your saving account outside of SMSF, the only way you can use it is to contribute to your super. It comes into your SMSF as a contribution, subject to the contribution laws. And once, let's say you contributed 50 grand from outside of your super, from your saving account into super, then from within the super, you can invest. Mind you, with that comes the restriction of redemption of that money. You can only get the money back at retirement, at your retirement phase. So once you've contributed, you've contributed. Hence, personal money, if you have within your contribution caps, if you are allowed to contribute, yes, you can contribute. Once it goes into the super, you can use it to buy under your SMSF. A related question, is $200,000 for SMSF enough? For SMSF, definitely enough. Cost, whether it's good enough for your costs, whether it's good enough for what you are going to pay to set up an SMSF, yes, obviously, yeah, there would be, it's a plus and a minus for everyone, depends on what you make out of that money. I've seen people setting up an SMSF and then they start worrying about whether I should invest in a property or not. Then they would start doing stock trading of their own, or then they would start investing into some things here and there. Or worst case, I've even seen people doing nothing out of it. Not worth it. But if you are really able to invest in $200,000, roughly, you can buy about 625K kind of a property with a 20% deposit and a stamp duty and a buyer agent fees and some money which you keep aside for your next 2 or 3 repayments, which you normally advise to people. 200K is enough to kind of invest somewhere there, leaving a bit of a buffer in your account. But yes, 200K is good enough or not depends on the capital gains you get, depends on the properties appreciation you're getting, depends on the rental income you're getting, whether it's worth it or not. And that's where the strategy comes into place about how do you invest into property through super. Do you do new or established properties, Julius? When you want to take it?
Yeah, we only do established properties. As we say, main fundamentals are wherever the supply is lower, demand is higher, we have to create the value for the properties. In established markets, there is enough approach where we try to find the market where because when we'll go for the new home and land packages, right, the more land is releasing towards wherever the more land is available. So there is always a possibility that there will be a lot of options to the investor. Second thing is the amount of land component which you'll get in home and land package, where the proportion of the house will be much higher than the land component. So land is always appreciating asset with the good location. So that's why we only focus on established markets.
Okay, the next question I'll ask you, Julius. Do you oversee or assist in renovation or subdivision developments or something of this?
We do in few cases. So like I have done my own renovation projects. We got few subdivision projects running across Australia. Also, sometimes we assist investor to we finalize the property. We according to the strategy, we find the property which will have a granny potential. We work with the council, get all the plan approved, and then we'll help them to put the granny flats also. So we do that actually.
All right. And have you worked on subdivisions or flipping kind of properties as well?
Yeah, I do. So Flipping, yes, I'm working on my fourth project now, which is in regional NSW subdivision. So far, I've done 3, and then probably more to come up.
All right. Thank you very much. Guys, we are at 8 o'clock, but we have a lot of questions, and I'm so sorry we are behind on answering them, but we'll keep on answering. And I would request you, if you're short of time, so thankful for you to have come in. But if you have time, there's some very interesting ones there, and I would, if you can, please do be a part of it. Okay, the next one. Can I move my property under my name to trust or SMSF? I'll answer this, Julius.
Yeah.
Yes, you can. You can definitely move between a trust or an SM from your trust to yourself, or yourself to a trust, from an SMSF to yourself, or vice versa. Just remember this: each time the legal entity or the legal owner changes, you are subject to capital gains, you're subject to taxation, you're subject to stamp duty payment, depends on the state. For example, I own Parag Dixit, I own an X property, and I have a trust called Parag Dixit Trust, and I want to sell it to Parag Dixit Trust. From myself, Parag Dixit, if I sell it to Parag Dixit Trust, then Parag Dixit as an individual now has sold a property of his own name, which means that I have, let's say I bought it for 400,000, I sold it for 600,000, I've got a 200K of capital gains, and I have to pay capital gains tax on that. Parag Dixit Trust, which has now bought this property for $600,000, because it's a separate entity, it's buying out of me, it has to pay stamp duty on that price. And its journey starts from $600,000 and so on and so forth. So, 2 properties, you can do that, but be mindful of these 2 important factors, which can change your decision about transferring the properties here and there. But yeah, there are a lot of people who do that, and there are benefits in doing that. It's a longer discussion to make. There are times where people transfer from individual to SMSF and all that stuff, but there are specific benefits they are looking at, and if you are finding those benefits which really help you, do that. If not, please be aware that there are these risks which come in there. How much do you, 2-3 questions I think together. So how much do you charge? What's your package, inspections, solutions, and managing the process? So related to Propwealth, cost, charges,
Yeah.
and what all does the process carry?
So our prices are, we charge around $12,000 plus GST. In that we find the property. So first of all, we start with the strategy, because individual require a tailored strategy as per your income, your requirements, and what you would like to achieve in your life. So according to that, we create the tailored strategy. With that strategy, we suggest the structure. We refer to the accountant, we refer to the broker or in-house broker. We have an in-house solicitor also. So basically, we look for the structure. Once the structure is finalized, then we start looking for a property as per your strategy. That would be anywhere in Australia, which will have a good growth and the good location. We do full due diligence of the property. When we do the due diligence, we consider all the major factors like flood zone, fire zone. Then we look for the easements, we look for the covenants, caveat. We run the contract through our in-house solicitor. Also, we check in all the financial angles also, and then we select the property. We give the reports to the client with the cash flow analysis. So when you're buying this property, how much would be your out-of-pocket expense, pre-tax and post-tax? And that is just a suggestion, because we are not a tax agent. So we give you the tentative figures. We also give you the reports why we are buying there, what are the future aspects of those suburbs in the council, and how much would be the future potential for that growth. Once the property will be finalized, we select this property, we work with you on the contract, we work with your broker to get your loan, we arrange the building inspection, we run through the building and pest inspection reports. If there are any concerns, we run through the inspectors, we work through the trades, we work with the real estate agent, through the solicitor, we try to fix everything. It depends on the state law. And once the property will be unconditional, then before the property will get settled, we arrange the rental management side of it. So we have a good affiliation across Australia. So we contact the real estate property management agency. who can manage your properties, and once the property will be settled, then property management services will start. After that, what we do is we monitor your portfolio. Every 6 months, we do the valuation of the property, and once according to the strategy, once the property is equity ready, we work with the mortgage broker, and then we start with the next purchase. So it's end-to-end solution.
No, thank you for that. That's a good detailed explanation, Julius. I know, guys, sorry, we are running really over time, but I want to take this last interesting question. They're asking us, what are the examples of the suburbs which you've really done very well? I don't know what it means. Maybe they are asking us, have we found out some suburbs through Propwealth Next and which have done good, which have succeeded in getting property people value out? I don't know. Can you answer that? Do you have a couple of suburbs in mind which you've helped people invest earlier and they have done, and those
phenomenal well?
Yeah, they've really grown well.
Yeah, so there are a lot of suburbs within the Perth regional NSW. So like we have invested in Hawking, we invested in Ellenbrook, Eveleigh, Brabham, Dayton, when people were investing into the Rockingham. So we were looking into the more locations where they'll be into the similar demand and supply ratio gap. But then when we look at the Propwealth Next, we look for the fundamentals, incomes, we look for the affordability index. So those locations were much better than what we used to buy in Rockingham. So basically, yes, those places were outperformed. So basically, in 2022-ish, when you look for the median prices for the Rockingham was around early 5. Similar into the Hawking also. Now, if you look at the median prices, Rockingham is sitting at around mid to high 600s versus Hawking is around 800 and early to mid 800. So suburbs outperformed. Similarly, we did a predictive analysis for the regional NSW. We bought in Albury region for 350, 360K, and then now the latest valuations coming up after 6 months is around 100 to 150,000 more range. So that's how it works. So yeah, so we purchase into the multiple locations with this system, and it gives us a good result.
All right. No, thanks for that. No, thank you. One more last question, I think, and then we'll not take any more. What are the advantages of one or multiple trusts in properties with respect to borrowing capacity and equity? Okay. All right. Okay. So what are the benefits? Very simple. So there are within the boundaries of what you can do in terms of buying investment properties. If you got enough equity and if you got enough cash and deposit, you can buy multiple properties through trust structures. The biggest benefit of a trust structure is to be able to maximize the number of properties you can invest in, to grow and have a large portfolio which gets restricted under an individual purchase. It's what you can do is, let's say as I was explaining during the presentation, if you've got 3 properties which are taking care of each other and you have no liability, there are a lot of banks and lenders who are willing to not worry about that trust, and then hence you can open another trust and you can buy multiple properties. People use these structures to be able to buy more and more and have a larger portfolio under that. People are also able to utilize taxation benefits which come along with it, which is again a longer discussion. Equity cash out, borrowing capacity, definitely. So if you have a trust which has 3 or 4 properties and that the trust can take care of itself and it doesn't need you to really touch upon your income, then and you are able to remove that 3, 4, 5 property trust from your borrowing capacity calculations, you start from scratch and you again are able to utilize your income to be able to borrow more. That's a typical standard strategy which a lot of investors use to be able to maximize the number of properties they can invest into. But mind you, this is not something which is a do-it-yourself strategy. It is more of a strategy which you should sit with your mortgage broker and make a plan and then come across with it and help you achieve that. Equity cash out, definitely. So whatever you've invested into the trust, as your equity grows, you're able to take a cash out within that trust, and you can even withdraw that money which you lend to your trust to be able to pay your deposits to buy the multiple properties. Equity and power of leverage. I think we'll be touching upon that in our next webinar next Tuesday. But power of leverage and equity cash out is one of the best tools to invest by just using minimum of your money, using the equity which you've generated in properties, and are able to utilize that to buy more and more. That's the strategy which you and me and everyone who would want to invest and everyone who wants to have a great portfolio should use. Combining it with the locations, combining it with the suburbs you can invest in, combining it with all this knowledge, combining it with the good investment strategy, portfolio creation strategy, and good team around you, you can really do very well in this market of investment. Anyways, I'm so sorry guys, we are now at 8:11 and it's pretty late in the evening, much beyond the time where we had committed to finish. There's still so many of you who are there, but I'm sorry, we can't take any more questions. We would request you to just take an appointment, book an appointment with us, go to our website and you can book an appointment there, or you give us a call. Our numbers are there on the screen. If you missed writing it, our numbers are freely available online. Give us a call, write an email, get in touch. Happy investing. Do good. We'll see you in the next week, in the next webinar, or we'll see you in our appointment, or we'll see you sometime else in webinars or in seminars or in property expos. Wherever we see you, we're happy to help. We're happy to give you our points of view on this.
Yeah. Thank you so much for joining us today.
Thank you so much, guys. Thank you very much.
Thank you.